Hello, YouTube. It looks like we're getting a lot of warning signs that we could be repeating 2008. Jerome Powell spoke and he moved the market. We went down by 3-4% on the S&P and the NASDAQ on Friday. So in this video, we're going to try to go through and explain where we left off last weekend when we said the stage was set. Why? Because we were right here around that 50 weekly moving average, where back in 2008, that is where we got our kiss of death, where after we lost that area, we just went down, down, down. So here you're going to note that we're here in 2022. We have a head and shoulders, and there are two key arrows pointing to the period where we briefly fell below the 50 weekly moving average, bounced back above, but then decisively lost it, where we have an inverted hammer. Same thing has happened this week. Now we're going to go all the way back in time to 2008 and see what exactly happened and whether or not there are things that are matching it from here. All right, here we go. Here we go. So we now see that we have our head and shoulders going back to 2008. We have our arrow. We'll hide everything to make it a little bit more clear. So here we go. We lose the 50, bounce back above. Then we got what? That's a kiss of death. We lose it once, lose it twice. That is over. It's over. Game over. On the second time, we come back up after forming roughly a W. We come over here. Another inverted hammer. And what a massive stomp. An incredible move lower. That is painful. That is dreadful. And from high to low, that is a decline of roughly 4.7%. Let's go back to today and just keep in mind whether or not these things look similar. So what I want to do in roughly a few minutes here is to just explain at a high level what is happening on the chart. Then we'll talk about what did Jerome say and what do we do from here. Because if it really is 2008, oh boy, do we got to buckle up. There is a long journey ahead. So now let's go back to where we are now. Okay. So the bear story we've been talking about since roughly January of this year, again, it moves slow. These bear markets move slow. This is now looking a lot more like a bear market bounce. The notable difference here is that we also have the gap filled. So is it actually filled? 421.22, 4219.96. We got about a $1 gap. Not that big of a deal. We have previous gaps lower on the chart as well to fill. And what I would note is that if we're going to repeat 2000, as I'll review some summary notes later, the last thing we want to look at here is going to be this 200 weekly moving average. So if we actually fall below the 200 weekly, that is where we confirm it's 2008. We're quite a ways off of that. We've now gone up by roughly 20%. And from high to low, this week we're down by 4. Looks like we're starting to track 2008. So from high to low here, we're down by about 6%. Didn't happen in 1 week this time, happened in 2. But we went up by roughly 20, and now we are down by roughly 6. That's 20 steps forward and 6 steps back. However, it's important to step back in time and realize that we've been trending down for more than 6 months. So this short-term rally is what we're really talking about. And now, as we smooth out the data and have a look at the volume, it also starts to confirm that we're starting to see the volume pick back up. All the recent volume here is notably red, and we note that we had decreasing price, let me delete everything here. So going back to our move higher, increasing price, decreasing volume. And now on the move down, volume is ticking back up. That means that as we're going lower, the volume is starting to confirm the move. We do not have enough weekly volume to say that this move is going to be persistent. It is going to be real because going back here, we got to see at least 1 week to do this. If we're going to get it, it should be this week. We're closing for 2 consecutive weeks at the weekly low. There's pressure building up and it wants to release. Let's go back to 2008 and just check it one more time. And then we're going to go forward, see what Jerome said, why this moved, and then we'll make sure you are prepared for this next trading week. All right, here we go, 2008. So again, what we're going to be looking for is going to be that 200 weekly moving average. So bounce off it once, get back above, reject. Then we confirm by falling below, bouncing one more time, and then rejecting at that 200 weekly. So now we're going to be looking at this period right here where if we're starting to decline, it's going to take about 10, 11 more percent before we actually get this move in 2020. Dead cat bounce and then reject. That's where the big nasty cut comes. So if this is truly 2008, we have got 10 innings, and I would say that we're in roughly the third. I still believe there is a bull case, and I will give you that shortly. So again, in these weekend videos, we try to provide a balanced perspective where we're providing the bull case, the bear case, but then the base case, meaning what should you just be watching for next week? Not what would cause us to be bull, what would cause us to be bear, but what is most likely going to happen, because it's great to have these theories, but our goal is to make money. All right, So now fast forwarding to today, now that the stage is set and we're seeing bear evidence, but it only really came through on Friday, we're now going to delete this portion here, which says 2008, and then we're going to go on with the normal show. So from where we are right now, we note that we're down by roughly about 6, but for us to go from the 50 weekly to the 50 weekly to 200 weekly, it's about roughly 18%. We're about a third of the way there. We're in the third inning if we're truly going to get this next leg down. This is also really interesting to me because as we look here to our low, which we set in June, if we put the magnet on and we use a horizontal ray, we snap that out. At a certain point in time, this 200 weekly is going to curl up to meet that low. And if we're going to cut, I think it would be pretty dramatic if we went down by roughly 12% in 1 week or 2 weeks. It could happen. I was pretty surprised by what happened on Friday, to be honest. Yes, that's right. I am human. I make mistakes. I'm right. I'm wiser than the average bear, but I'm just a human too. I make mistakes, and I got legitimately surprised on Friday. Here we go. So now we note that if we were to fall down again, roughly like 2008, even if it's dramatic, probably going to take at least a few weeks. That 200 weekly can match our low, and then by what? Making a new low of the year, and then rejecting off of that 200 weekly. That is how we truly know we are repeating 2008. So as of right now, we know that in 2008, we went down by roughly 50%, 50. We are down by roughly, I don't know, I think it's like 12, 13%. Let's double check. Here we go. So we're now here to 15%, which means we're what? About roughly a third, right? 15 times 3 is 45. So we're at roughly 1/3 of the 50% move, or 1 out of 3. And we're also about 1/3 for us to go back down to our 200 weekly. What does this mean? It means there's tons of time. There's going to be tons of time for us to go back here. And we're roughly 1/3 on both. So if you're bearish, again, congratulations for catching the top. You top ticked it. What's generally easier is to wait for the reaction than to try to predict. When you're trying to predict, you're trying to be right. Our goal in the market is not to be right, it's to be profitable. We are never going to be perfect. So if our goal is to make money, I would say that now team probability and team risk reward is probably skewing bearish in the medium term. Again, you can go back and look at 2008, the week that I'm trying to compare to, there was a violent snapback. So the flip side here is that after we see some of the sharpest declines, we generally see some of the strongest snapbacks. And I don't have the stat in front of me, but we showed you an article on a previous weekend video where we show that by just missing the 2 best days of the year, your gains over 10 years actually go to 0%. That's right, 0. Because those snapback days of 3 to 5% are really going to make a big difference. So if you're an investor and you have stops in, either let the stops hit or don't do anything. So if you would have been invested continuously on average, the S&P returns a compounded annual growth rate of 10%. So that 10% only happens if you are able to stay in the market. And if you're trying to time it, again, it's not that you can't do it. That's what the purpose of these videos is for. But we have to be mindful that this is very difficult. Timing the market is like really hard. Being right and making money are two completely different things. There's one more thing I want to talk about, but it's kind of escaping. Oh, I remember now. Sell in May and go away and come back on Labor Day. We're going to talk about this a little bit later in the show, but let's ask ourselves, if we're going back into a normal market, what are we doing? Where's May? Oh, geez, right? The May monthly close is at 412.93. We're currently here at 405. So if we take, again, we were lower in after hours, but we'll call it 405 just for the cash market close. 405 divided by 413 minus 1. It means that we've actually gone lower by about, about 2%. So sell in May and go away and come back on Labor Day. Would you have really known there was the stock market crash of 2022 if you would have known that we were only down by about 2% back to May, which is what the normal saying is, sell in May and go away and come back on Labor Day. And Labor Day is going to kick off after next week. So wherever we close, if we do get a snapback of 1 to 2%, we would be pretty close to doing a whole bunch of nothing between May and now. That is truly incredible because Jerome really, again, I don't think there was anything like really that was like earth shattering in his commentary. I just think the market had to reprice, and it happened in a hurry. Every cycle's happening faster and faster. And the most important thing that I heard from Jerome, we heard two things. I'm going to show you the evidence here in a moment. I heard two things. I heard I heard the dove side, which was we're going to be data dependent. So Team Bull, right? They got their evidence. However, this was already kind of known. It was already priced in. So that's why we went up by 20%. That's called the Powell pivot. And that's what the market already knew. If the market already knows something, that's called buy the hype, sell the news. It's like, okay, well, what else? And then Team Bear is like, oh, but Mr. Powell, he told us that actually we have to say higher for longer. And I'm talking about interest rates. Right now, the market is priced for up into 2023 and then price cuts into 2023 and 2024, back down to that 2% target. So if we now look at the next thing here, this is what the market was pricing in. Totally incorrect. And that's why it corrected in a hurry today. We're looking here at the, again, at the blue line. And the blue line here shows us that, it might be the green line. I have flux on from my display. But anyways, this line right here, okay, we're going to raise into 2023, cut in 24, back down to 2%, back into longer term, 2025 and beyond. Jerome corrected that. And another way of looking at the same graph, again, both provided by Bloomberg and the Federal Reserve, if we look here, we're looking at forecast. We're looking at the forecast here. We're looking at the dotted lines. The first dotted line is December. So it will show that, okay, well, back in December of 2021, they're like, we're going to raise rates. So like, okay, cool, let's price it in. Boom, straight line up. That's what caused the drop. Look at the next meeting, the red dot, or the second dot's here. Up more, and then flat. Okay. And then now this most recent one here in June. Up, down. The repricing only happened at the June meeting. So what does this really mean? It means the market got ahead of itself. And when we hear the adage of don't fight the Fed, and this right here tells us that actually that's not correct. That's all Jerome fixed today. He just told us that, nope, we're going to say higher for longer. And I'll explain the reason why. I'll try to actually find the slide right now. That's pretty much it. They use PCE, and we got that reading on Friday. So I'll actually wait till I get to the fundamental portion of the show because I don't want to overwhelm people with trying to mansplain or trying to dive too deep. It's really simple. Back in December when we started the big move, boom, right? Market reprice. It's like, oh crap, higher, and higher. And then at the next meeting here in March, the red dots, higher, flatline. Oh, right? Breathe a sigh of relief. Oh my God, they're going to flatline it, right? That's called a pause, not a pivot. And then over here in June, we got oh my God, they're going to pivot. So it's that simple. Back in March, and again, sell in May and go away and come back on Labor Day, March, April, May. It's right around that area, Q1. So after Q1, going into June or Q2, again, market had its biggest leg down in January, December, and January. Oh man, that's like right around when they told us it's up. Yep, rates only go up. And then in March, again, up, flat. So the market's like, okay, well, let's price it all in. And then in June, it's like, whoo, this Jerome, this guy is so cool, so sleek, so sexy, up, down. Incorrect, but that's what the market priced in. So Jerome was just there to tell it, hey, Mr. Market, you're actually incorrect. So I think there is still a chance we can avoid 2008. But for this weekend's video, I think it's most important for us to try to just look at the evidence for what it is. Instead of trying to tell the charts what it should be doing, we're just going to look at them and be like, well, what's the story? I want to understand what's going on. I don't want to tell Mr. Market what it's doing. I just want to try to understand. And 400 is going to be a critical area for the bulls this week. So now if we just look at our normal charts, which we look at every week and every day, now we just note that there's 400, there's 404 or 405, which goes back to our Joe Biden. I forget what this was. This was the vaccine, I think. Vaccine gap and go. And then we got then we got the Biden, right? Biden win. There's the pumps. And that's what we're retesting here. We're retesting the Biden start of the big move higher, the blow off top. If we can hold it, I'll be watching that 410 and 420 area or the relative lows for key areas. You're also going to note that there is green for support. Support is found at 400. The pivot is going to be here at roughly 410. And then the red line or resistance is up here at roughly 420. And the reason why these levels are so important, notably 420, is that would be a weekly higher high next week. If the bulls are unable to reverse from here and course correct back to the 50 weekly, I don't think they're going to be able to. The pressure is building up to the downside, and it's likely going to release. By losing the green line, we're probably going lower, probably eventually to either the psychological if 400 is lost, we're probably going back down to test the lows. 360s, 350s, I don't know, lower. We got bear market targets we'll look at a little bit later. So in about 15 minutes, that's really what happened. If it's going to be 2008, it means that we're going to get a nasty surprise, and it's going to be important. We can also note here that we're falling back into fear. So the stock market did briefly get back into greed, which looked like it was a bull trap in hindsight. Boom, into neutral. Boom, right into fear. So we're seeing some of the recipes set up here. This is where it starts to thicken. The plot thickens a little bit. We're now going to flip here to a different point of view. I'm actually going to clean up the boards here. Let's go to 3. Let's go here. Let's go SPY. Yes, I'm pushing buttons. I'm doing stuff. Here we go. Let's flip to a line chart. Done. And now we're going to note that this is something I shared on Twitter. I actually shared this on the community tab. And thank you very much to everyone who went into here and actually engaged. Notably, Jake. Jake really left a nice comment. Stefano, congratulations to you, my friend. Looks like you crushed it this week. And there's a comment somewhere lower. Someone also telling me that I misquoted, whatever. Anyways, this was my thesis. I thought we were not going to hear I thought Jerome was going to kind of toe the line a little bit more, but he wanted to re-anchor inflation expectations. Again, this is what he should have done, so it's great. And instead of trying to predict, we're going to react. So if now we look here at the chart, this is what I thought was going to happen. History does not repeat itself, but it rhymes. So we look here at SPY, BTC, and then ARK. These for me are, again, the blue chip and then the high risk. So BTC and ARK, in my opinion, are high growth. And those are largely priced on what the 10-year note does. So if we're truly going to raise rates more and inflation expectations are for higher, then we should be seeing that reflected in the big blue chip, which is SPY, but then also in BTC and ARK. And these charts are looking, they're looking a little scary, to be honest. But it also tells us that we're closer to the end of the move, because from here, it's not a lot lower for us to hit our all-time low than it is to go back up to the top. Isn't that the truth for ARK? It's like already down by 80. BTC is like, I don't know, went from like 60 down to 20. That's like 60% down plus. Okay, well, it's going to go down another 90. And then for SPY, well, this one here is like holding up a whole lot better. That's correct. Why? Well, because it's probably starting to go down, but it's not actually confirmed. Why? It's holding the uptrend. So it's holding the uptrend. But this 420 area is right where we find that pivot. So if now we go back here to SPY and we're looking at a line chart, which only shows us the Friday printed close, because we're looking at a weekly chart and it's just a line chart. There's no noise. So what we note here is that 420 area is going to be where we find that psychological area. We're now just going to zoom in here. We're going to can I zoom in? Let's open up the chart on the next image. Then we'll just zoom in here to the image on the right, because I just want to focus in on this part right here where we note that again, we have a pink line, which is our uptrend. We have our 2 lows. That's a pink one. That's a red one. Our red one is our impenetrable fortress, or 454. So it's 454 here. Now we note that as we go back to here, if we can't hold 420, we're probably going to come back down and test this uptrend. And if we lose 395, we pretty much lose the uptrend, which is what I'm relying on. That's my thesis. My thesis could be incorrect. That's right. I'm human. I can make mistakes. I thought we were going to defer our move all the way to January, where we come down to the end, lose the uptrend, and then that's where the waterfall starts. I think we could start feeling some anxiety. So if you look here too, what the market should be doing, right? This is kind of what I even said to myself, complacency. Right? We just have to cool off for the next big rally. Yeah. That sounds exactly like complacency. And as I think about it right now, that's kind of what I'm telling myself when we dip down to the 50 DMA and curl, right? Just got to cool off for the next big rally, bro. Whoop! And that's kind of what I said on Friday too. On Thursday, when I said the big one's coming. Just have to cool off. The big one's coming. The big rally's coming. So that kind of lines up perfectly with the psychology motto as well. Look at the next one here. Anxiety. Why am I getting margin calls? This dip is taking longer than expected. So we've seen margin calls in Bitcoin. We've seen margin calls in ARK. We've seen margin calls in meme coins and all that stuff. But I don't think there's been major institutions. Been a couple. I think it was Tiger, and then there was a few other ones. I forget. But they got margin calls. Some are blowing up. But not enough damage to say there is a systemic risk, which is what Jerome is more concerned about. He's going to keep moving fast until he breaks something. And that's what he's doing. He's moving fast on rates. So if we go back to SPY now, we think about this. Okay, well, 395, that kind of seems like a line in the sand. Yup, that would be below 400. It would be below the 50 DMA. We're already below the 50 weekly. That kind of seems like trouble. Yeah, that kind of seems like trouble. So looking here at our daily chart, 398.56 is our 50 DMA, but it's curling up. So it's probably going to be around 400 by midweek to late week. So to keep it really simple, if we lose 395, we get a more credence or evidence that the bears are going to try to go for it to lose that 200 weekly moving average. We dead cat bounce back up to test it. What do we get? Oh no, that's like a big nasty head and shoulders. That's correct. So there's going to be multiple points to enter this trade bear if that is the true move. I really like this area right here where we're already going down. We dead cat bounce back up, and we capture most of the move. I'm actually really curious now if we go back to 2008 and we just have a look at what the percent decline was after we actually lost that area. And I have my falling wedge here, which also ultimately broke out, but was a failure too. Again, this story just takes a really long time to fully play out. So now if we look here at our dead cat bounce to our 200 weekly moving average and the rejection, looking at this period right here, right? We lose the black line or the 200 weekly, dead cat bounce back up, and then we fall down like a lot. Looking at this period right here. I would also note that the death cross shortly crosses after that, which is kind of where we are now because we had our cut in 2020 and cycles are happening faster. So the 2000 and 2008 was the retrench or the repeat from the big cut we had before. It took 10 years to get all the way back to roughly where we were. Sorry, 8 years, something like that. From the low was 5, right? But anyways, if we now look at the percent decline after we lose the 200 weekly, if the bears are correct and you guys are using stops, congratulations. If you're right, you could potentially make another 48% from here. That is a lot. That is everything where it is right now, going down by another half. Bitcoin to 10K. SPY to, what is it, like 200. Yeah, 50% lower from right here. That is low. That is low. That is low. So there's going to be tons of time. And for me, I still want to be a little bit optimistic, and I will tell you the reason why. I think a lot of this was priced in. Why? People like me knew the market was not being efficient. We knew we should not be up here, but we are. Why? Liquidity. And because why not? So now we're going to look at the next two charts here just to see whether or not, again, the blue chip is earlier in the cycle. That makes sense. We're at complacency. Just got to cool off for the next big rally. Justin said so on Thursday. Got to make sure he knows that he was wrong. Anyways, drop me a comment. Let me know what you think. Are we bullish or bearish? Am I right or wrong? I just like reading the comments, to be honest. I like all of them, good or bad. Moving forward, so if the blue chip is currently early cycle, are the other ones showing there is some evidence for us to be a little bit scared? Now we look at BTC and we note that we're late cycle. We're way into panic, capitulation, anger. I think if we lose 20K, anger could start coming back in. I don't see a lot of anger right now, but below 20, I think the pain threshold would start to increase. Let's look at BTC now. Oh boy, our 20K area is also the 2017 top, the first big booms in crypto. Then what happened? A big lull from 2017 to 2020, 3-year lull, and we went down a lot. So if we look here now to where we are, again, already down how much here, right? Already down by 70%. Yeah, that's a nasty cut. ARK down by 80, BTC down by 70. Yeah, you got 30 out of 100 cents left, and we're hovering here at 20K. That's why I'm watching this really close. So we came up, right? We dead cat bounced off the green line, moved back up here. We rejected again, which means now we might be going down to make our progressively lower low. Then we could dead cat bounce up one more time to hit our uptrend and then come down. Why is this so important? Oh man, Justin, don't tell me that this is so simple. Well, look at the 200 weekly. It's starting to curl down here. So if we bounce back up one more time, we could ultimately do this. Get a little bit of, again, a cut down to here, come back up, boom, right? That's if we avoid the recession. If we get the big recession, well, maybe we don't do that. We actually go lower. That's my base case right now, though. So again, even removing all the lines here, if we bounced up and tested the 200 weekly, that would be a short. Why? We lost it. We're reclaiming it, lost it again, and now we're testing it again. That is a short every time. So that's the same thing setting up here. The psychology also matches. So you know those memes of the guys crying, right? Right? They're too smart to sell, whatever. That's what it seems like. Then we look over at ARK. Oh man, already death cross. Yep. So we already have a death cross here. Now let's flip to ARK. So looking here to ARK, right? Oh geez, right back to the green line. Yep. So we went up, we went all the way back down. Might go a little bit lower, right? And then what? Oh, that's right. Like even in 2008, we snapped back. Yep. So the difference here is that we're quite a ways off the 50 and 200 weekly. They're up here at 70, roughly 100% higher. So same thing here as BTC. We're most likely, or my base case, not my guarantee. It's not the Justin guarantee. I'm just a guy on YouTube. If we were to coil up here, maybe go a little bit lower, come back up, and then we rally up. If we avoid the big recession, that's a cycle. It's done. It's over. Time to go back up. Right? People start to believe it. Oh, my retirement money's lost. How can I buy all the new stuff? I'm an idiot. And then you're like, oh, I don't believe this rally, suckers rally. And then boom, big leap up time, right? We go up. Why? That's when we get the true pivot. This was premature. And here we go. So this one's done and out. Something else I want to look at here is just the flow. And again, we're really excited to announce that if you click on the link in the description, our new website is live, thealgo.com. If you stay tuned to this channel and just subscribe, or even drop me a comment and let me know what you think, whether you're a current member or you're looking to join. We're going to be launching a really big update in the next month. Really encourage you to subscribe to the channel to hear more about that. But anyways, here we get this proprietary stock flow here, and really encourage you to look at that one. We're going to reveal some goodies for you today. So if you're watching into the 26-minute mark of the video, please make sure to drop a comment. I would really like to know who are the people watching this far on. So when we look here, we'll talk about the stock flow, which is another big confirmation. Even if I didn't tell you this stuff, I'm already building my case for the bear move lower. And then we look here at the flow. JD, there's easing happening in China, and they got 29 million and 27 million. Looks like they're buying again. They're buying September and December. Again, in the money, which means they're just trying to get exposure. This is an easier way for them to get it. Then we look here too. They're the big orders, right? Charter, Russell, EFA, Docu, TLT, Clar, Tesla, Upstart, Silver. These are all $5+ million orders. They're all bear. So there's a lot of bear bets here. Then it's a little bit mixed. But if we look at the flow for the week to date, it's 47% calls, 53% puts. We're only looking at orders over $100,000 because, in my opinion, that's all that matters. So it's still pretty deadlocked here. There's money to be burnt on either side. So where we start the week versus where we end the week, it could be very different. Just like last weekend where I said the stage is set. I don't know where we go from here. I'm going to watch. So again, now we're going to look at something else here, which is the stock flow. The reason I'm going through this is because I think it's time to sound the warning bell, but I don't want to talk about it at the beginning of the video because you only deserve it if you're watching all the way through to understand what this means. Because a number without context is just a number, and a signal or an alert is just a signal or alert. But it's become very easy for me to understand what the algo is telling me now by simplifying with KISS. Keep it simple, stupid. The reason why I got really bullish on the market in July was because we got this invest alert, which for us is good up to roughly 3 months for the ideal holding period, if it's over its 50 weekly moving average. So SPY here was at 388. It's still at 404. It's still quite a bit higher than that area. So if we fall below 395, but then also fall below 383, we've puked up, not just 400, not just 395 to break the psychology chart, right? Not just, now we're also losing we rejected out the 50 weekly. We're falling back below the alert price, which means this was, again, an algo dip, a rip and then dip. So this was just, the move is over. The move is done. We started printing weekly lower lows. It's donezo. It's also below the 50 weekly. We looked for that to get reclaimed within the first 5 weeks. It didn't do it. And the attributes here are something we added in because that's what I really like. Anyways, that's a single alert. It's on SPY. QQQ and the other ones just got ahead of it. So now we compare one alert for SPY, which was under the short-term price or the 50 weekly, but over the long-term price or the 200 weekly, compared to what we've been getting since what is this? Beginning of the month. First thing we got was TNX. We got an invest alert for TNX, which means it thinks the 10-year treasury note's going to go higher for the next 3 months. DXY at 106. It thinks the DXY is going to go higher for the next 3 months. Then we got PSQ, which is the opposite of QQQ. It thinks it's going to go higher for the next 3 months. We look at DOG. It thinks it's going to go higher for the next 3 months. Inverse Dow. Look at SH or inverse SPY. It's going to go higher. RWM or inverse ARC. This is the perfect storm for the bear thesis, and they just went off, which means that I already told you we're looking to push off this moving average here, right? If we hide everything again, if, again, now we flip to SH, oh, it back tested the 50 weekly and is bouncing up. Yes. So if this makes it easier for you, look at SH, which is inverse SPY. We can also go I think it's 1 divided by SPY. We can note that, oh, that looks bullish to me. Right, yeah, exactly. Just flip the chart upside down. Is this bullish? If it is, then you should be bearish. That's what it's telling you. So just know what team you want to play on and then figure it out. But every single one of these is what I've had in my bear thesis for quite some time. And let me see if I can just jump down to that right now, because I think, do I have it here? Ooh, I got a lot to go through this week. Anyways, let's see if I have the... give me 1 second here. I'm actually going to pull this over to the screen, then I'll pull it back. 1 second here. So, what was I looking for again? Justin's having a brain fart because he's recording this at, what time is it? 9 o'clock on a Friday? Yeah, 9 o'clock on a Friday. All right, anyways, just give me 1 second here and I'll pull it up. So what this really tells me is, where's my bear thesis? Here we go. I have it in here. Where to put it? Notes. I have it on my desktop. Oh, I know where I put it. Sorry, 1 second here. Why bull or bear? So sorry for the delay there. The reason why this is really important is because each one of these alerts, I understand what they're telling me. And when I look over here to the attributes, we don't pull a price for DXY or TNX, but it's above the 50 weekly and 200 weekly. All these other ones here, they're all above the 50 weekly, which means they're above their short-term price. They have momentum by definition. We look here to my Y bull or bear. Look at the bear case here. 50 weekly moving average rejection, which means SH is over the 50 weekly. It's starting to repeat 2008. DXY and TNX breakouts with the juice or the algo to confirm it. This is a super strong signal for me. Incredibly strong. 454 unpenetrable fortress. Yeah, sayonara. We're not going to 450s if we can't crack 420. Deep recession risk. We'll look at that in a moment. And then Tara. The problem is Tara right now is kind of looking like Tina. You want dollars, you want US stocks, you just want US. Trying to kind of confirm it too. They're like, okay, yeah, I guess we got to stay on the US boards. We'll do whatever it takes. We'll compromise on everything. That's a huge tell too. There is no alternative. People aren't going to go to Hong Kong. I'm not putting my money in there. No one wants to. So that didn't work, right? Sayonara. And Jerome kind of knows that too. He needs optionality. It's the reserve currency. It's really important. So now I'm going to close this out, and hopefully you really appreciate this because this has been years of work and, again, a lot of money in the making to build this system. And I'm telling you because I think it's worthwhile to tell you the story first and then provide the evidence after that. It's not just fundamentals. It's the technicals. It's the psychology. It's the algorithm, which doesn't care about emotion. And now we're going to look at the evidence to back this up. Then we're going to wrap it up. And there we go. So Powell has a chance. This is before. This was on the 21st, which was 5 days ago. Powell has a chance to reset market expectations at Jackson Hole if that's what he wants to do. And over the course of these next couple of articles here, we're not actually going to read them. I'm just going to read you the headlines, and hopefully you're going to hear the story. I already told you that it's the yield curve basically getting repriced. Where we're not going to cut in 2023 or 2024. It's going to stay higher for longer. Lockstep markets prime for all or nothing Powell sweepstake. Yep, it was all or nothing on Friday, and the Bears really capitalized. Here we go. Looking at Jerome here. Yeah, he kind of looks like, a little bit, I don't know what I should say here, right? Oh man, I know what I'm going to say, but they don't know what I'm going to say. Powell's 8-minute speech erases $78 billion from richest Americans. Oh yeah, right. That's a hangover. Here's the actual speech. You can read it if you want to. I posted this thing in Slack in the SPX channel. Jackson Hole's Powell speech in 1 minute. They do a recap of, again, this is like summer camp for all the Fed officials. They're all there saying, kumbaya, we're all smart. Our leader's sexy. He's smart. He's powerful. Knows exactly what he's doing. He's incapable of doing harm. That's Jerome, right? The stock market wrote a love letter to him. He even had Larry Summers warm up to him. And Larry Summers said he is very pleased with Powell's speech. That is a huge deal. Jerome said he had 3 lessons to learn from, which means he's aware that if he keeps the current course, he's going to repeat history. Now we're going to look at 2 articles from before this went out as well. Not a tight monetary policy yet. Former New York Fed President Dudley. He was part of the Troika, so he can speak openly. And he is someone who really affected monetary policy. Williams has his current job right now, John Williams. So he pretty much said, no, not tight enough yet. Have to go to 4, maybe a little bit higher. Mohamed El-Arian, preview for Powell. He was kind of like, hey, I've been telling you, you got to reset expectations. That's what he did. That's why the market went lower. So it's not that the market was really surprised. It's that there were people who were positioned as if there was going to be all this fake money. And for me, I even went bull. I went long, which normally I would never have done. But price is king. Technicals tell us when to get in and out. Fundamentals tell us what should be happening. The market can remain irrational longer than we can remain solvent. Next thing here, we're going to look at, right, keeping the lights on in Europe will be very hard this winter. Yeah, when the market starts to go down, it starts to focus on the negative news as well. That kind of seems like, again, I think the European Union eked out a 0.1% GDP expansion, and they avoided a recession. But if it looks like a recession, it smells like a recession, but it's not technically a recession. Is it a recession? The next 2 quarters look pretty bleak going into winter, the fall and then the winter. Europe slides towards a recession. Oh, yeah, that sounds really encouraging. So the stage is already kind of set. And then some ECB policymakers want 75 basis point hike discussed in September. The world is going risk off. That deep recession risk that I mentioned under why bull or bear is starting to look a whole lot stronger. Let's open that up one more time and have a look at it here. So again, deep recession risk. Yeah, well, deep global recession risk, where the U.S. is going to get dragged down, kicking and screaming because it is the best. It is the best alternative. But at a certain point too, when the canoe is sinking, even the guy who can swim the best is eventually going to fall into the water. This is going to take time though. So looking to the next article here. And again, smash a thumbs up or drop a comment if you're still watching. Please and thank you. China trims lending rates again, 1 week after surprise cut in key rates before. What does that mean? They're already in easing mode. Things are already tough there, and they bent the knee and bowed to America and the U.S. stock exchanges, which are the most liquid global markets right now. So they're saying, yeah, I concede. This is a really big deal, by the way. Why they were going to get delisted? Get out of here. Go back to your country. And they said, actually, we like it, America. We like the New York Stock Exchange. We like the NASDAQ. We like the NYSE. Central banks won't spark major economy recessions. So where the U.S. is right now is a much different position than Europe or China, but it's the global economy which is in a problem right now. So there's contagion happening. And now I'm going to explain the reasons why I think that things might sound really bad, but there is still a narrow path for us to avoid all this. Now I'm going to go through and maybe explain a little bit of the minutia or the details of the reasons why what Jerome said really matter. So here we look at the real inflation rate for May versus June. We'll have a look here at it's roughly 8-9%. That's like really high. Yep. If again, in Japan it's 2.5, in China it's 2.5. I don't know what they're at right now. I think that number's fake. But anyways, I'm looking forward to what the Fed cares about, or PCE. So at 4.3 in 2022, 2.7 in 2023, and 2.3 in 2024, according to the Fed, they are on track for getting back down to 2%. Whether or not they're right or wrong, I don't know. It's a projection. If you take 4.3 plus 2.7, divide them by 2, you get 3.5. So at 3.5, that is where Goldman Sachs projected we would be by the end of the year. The thing I've been showing periodically for a while now, thanks to Mason. He shared it here. It's now been updated. So we don't hear that, oh, okay, so the dot plot told us that we have to go up and then stay flat. Why? Well, if we need evidence, not just, oh, well, the projection says 2.7. No, let's see the actual number for 2023. When we start making real progress on PCE down to this area, then we can start to say we're going to start to pause. Now, we're not going to pivot. We're going to pause. We're just going to stop raising. Higher for longer. It doesn't mean higher and then down or higher and then higher than pause. Why? They don't want to break something. So 4.3 this year is almost wrapped up. We're going into fall now, right? We're halfway through. So if we start getting back to 3, back down to 3 next year and then lower, a restrictive rate just means above this number. So if we're at 2.7, 3% would still be restrictive. They could take it down to 3.25, back down to 3. So jack it up to 3.5, hover there, likely for next year, maybe into 2024 even. That's what the market is repricing right now. And it happened in a hurry. But all it really means is an extra 25 in September. The terminal rate, or where we get to by the end, is still going to be roughly the same. So next article here. Powell's new guidance, higher rates for longer to beat inflation. Again, do you understand it now? We're not going to dip on, we're not going to cut rates. So if now we take what Goldman predicted, but we update it, because here they're saying by end of 2022, we're going to be at 3.5. And all the Fed officials are out there chirping today, telling us that roughly 3.5 to 375 is what they're looking for. James Bullard said 4. So 375 is like above the PCE's average for this year, next year, and it's even keeping James Bullard happy. So come on, like this is really hawkish already. So now we look here to the FOMC meeting calendar for the rest of the year. The asterisk or the star just means that this is a meeting associated with SCP, or Summary of Economic Projections. We got one in June, and that's where these numbers come in. And Jerome said, pay attention to these numbers in September. So we're currently at 2.5. If we go higher by 75, God forbid, not 50, we get to 325 by September, then we go to 350 into November, and then 375 into December, which means the market's going to start having a lower rate of increase. So we're going to get to a end of year rate of 375, or basically the terminal rate by then. And then again, look at the dates here. So in September, which comes up pretty fast in about 3 weeks here, 3-4 weeks, if they tell us that the SEP is still on track for the current PCE projections, or what the Fed says inflation is, because no one eats or drives or heats their home, right? No one does that. That's like totally not real. So we're just going to skip over all that. The core PCE is what we care about. So looking to September, we get an update. And then in December, which is right around January, that's when we get our next update. So if they're going to do a pause or a pivot, or we got to keep tightening, we're going to likely find out in September and in December. That's why those dates matter. They also matter for the psychology chart. Dot plot here, we talked about this at the beginning. So we're not going to go down anymore. We're going to go up and then flat. And I already kind of knew that. I think a lot of people already kind of did. But they're like, hey, the gravy train's leaving the station. Time to hop on. So money was made, and now it's like, yeah, well, right, mean reversion. Everyone just hopped out, right, racing for the exit. We talked about this too. So, right, there's the market dropped the most between December and here, because they're like, oh my God, higher, higher, higher. And then the meeting minutes in January confirmed what everyone suspected in December. Up, up, up. And then in March, up, up, flat. And then June, up, up, down. So there's the up, there's the pause, there's the pivot. The market acted just like there was a pivot. It got ahead of itself. It was premature. That's what Jerome corrected today. That's it. He said, actually, just make that a flat line. Is that really that big of a deal? Ask yourself that. Again, I don't know. That's why it could be 2000. It could not. We have more time. And it's not just the US is in trouble right now. So to go from 0 to 4, the market digested all that. Here's where we are. Now it's like, oh my God, it's over. We're going to go down. We're going to tick down a little bit. We're not going to tick down a little bit. We're going to go flat. Oh no, right? Run for the hills, run for the hills. And this could be it. We have to drop another roughly 10, 11% for me to say that, yes, this is 2008. But I thought you guys would click on the title and watch the video. So I put it in there, okay? That's right. And I'm telling you the story, reason why it could be. It's not going to happen tomorrow. It's not going to be 2008 tomorrow. It's going to take time. Now looking to the seasonality chart. August and September are seasonally, two of the only 3 months that are red for the whole year. And they're the deepest ones. Why? Sell in May and go away, come back on Labor Day. That's why. End of the summer, usually get Fed meeting. Again, the Fed stuff comes out in September. That's why. Now you understand it a little bit more. The stuff is complicated. So if you're catching a good portion of it, congratulations. You're pretty smart. We were actually at 405. I got dyslexia. So it's 405. And it's actually only a 2% drop. So again, sell in May and go away and come back on Labor Day. We'll see where we are for Labor Day. We're down by 2%. What does that mean? It means, again, just look back to this right here. We did most of the damage early, right? It was like a bull in a china shop. Up, 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 up. Up, up, flat. There's the pause. Up, up, down. That's the pivot. That's the market priced in. It's literally that simple. So don't overthink it. And when you look here at the average percentages, yes, if we're going into a normal market, and we're actually going to avoid 2008. Even Larry Summers says recession in the next 24 months. He doesn't say tomorrow, doesn't say next month, doesn't say next year. He says there's a 75% chance in the next 2 years. So, and this is the average over the last 25 years. We go down by roughly 0.6 and 0.7. Then we scoop it all back between October and December and more. So figure out which team you want to be on. That's it. Then stick to it. And the saying is, don't fight the Fed. And the commercials are not fighting the Fed. They're like, yeah, right, let's capitalize on this. We got 200 billion short, baby. Let's go. Biggest short position since 2015. They're ready. They want this. That's why they capitalized on it. So now let's look at whether or not there maybe the bears are a little bit too hawkish near the bottom. So we've been taken down for 1, 2, 3, 4 months. Now we're flatlining. We want to see continued data to go down. That's what data dependency means. We want to see a trend. So it can't just be we go down for a few months and then pause. We have to keep going down to get closer to 4, 3, then 2. We have a lot of work to do. And now one more thing here, which could, again, add a wrinkle to the fold, is going to be things like underwhelming Iowa corn crop set stage for more food inflation. We also heard about a thing out of India regarding wheat, where they're actually going to be importing, where they said they were going to feed the world after what happened in Europe started. And that's a big problem. Now we're going to look at one more thing here, so just bear with me. Here we get, this is from the USDebtClock.org. So if we're battling with Paul Volcker, again, it's one thing to raise interest rates to 20% when you're spending 34% of your GDP debt to GDP ratio. Now we're at 123. So the cost of servicing the debt is significantly higher, and we owe a whole lot more. We can't go to where Paul Volcker was, which means they're going to want to have the interest rate lower, because on 30 trillion just for the national debt, every percent matters. It really matters. Every single percent matters. It's hundreds of billions of dollars. So again, we have to really consider that. And then we started taking back down in fears. So what I'll be paying close attention to was not just the psychology chart, not just the fundamentals or the technicals. It's also just the fear and greed. If we now go from here and we start pivoting back into greed, or we start pivoting back into fear, that'll just confirm that the underlying market mechanics are confirming what we think. If we fall back into neutral after what happened here, it means that the market maybe have already priced a lot of this in. We had a nasty reaction where the wrong people got caught offside, and now we tick back into neutral. We go back down deeper into fear. That's where 2008 starts looking more likely. Extreme fear, that'll be near the bottom. It'll be like, oh, I guess it's extreme fear. If we start snapping back into neutral, that's where I start to get more bullish. Why? Well, again, only a week ago, we were at 51. That's solidly right at the middle. Now we tick down by 7 points. It's a lot, but it's not like a lot. And with that said, it's now a 47-minute video, but this should be your primer for what to do, not just for the next week, but really for potentially the next couple of years. So I hope you appreciate that we took a step back this week to understand where the market's going, where we're coming from, and where we're going. And thank you so much for watching. And I'm going to queue up a video here at the end if you want to watch more, which was our original bear market thesis of 2022. Thank you so much for watching. Look forward to seeing you next week. Thank you.